happy spring, everybody. Finally got some nice weather this last week or so, hoping that keeps up. In the meantime, we're going to get together today for our halftime report for the second quarter. It is about the end of May now, so we'll give you an update on everything that's happened since our last quarterly commentary. As usual, joined by our president and founder, James Bradley.
Hi,
Afternoon, Jim.
everybody. How are you doing, Sam?
I'm doing pretty well, thank you. All geared up for summer. I feel like I spent half the summer getting ready for it, but almost
That's
there.
right.
Great. So, per usual, give you an update on the timeline of what's been going on, how we're looking at markets, and the economy. Jim will give us a quick timeline of the rundown of what's happened so far this quarter.
Yeah, it seems like this has been kind of a long quarter so far, and we're just doing the halftime report now. You're not alone. If we go back to early in the quarter, April 7th, as a result of the war, oil hit $138. Next day, we got a ceasefire. Markets loved that. They surged 10% in April alone, which is an outstanding month, one of the largest single month increases that we've been able to record. Obviously, a lot of it a bounce back from from the first quarter's market decline. April 21st, the ceasefire got extended indefinitely, but the Straits of Hormuz remained closed. In May, we get Kevin Warsh confirmed as our new Fed chair, sworn in successfully by a relatively narrow margin in May, May 22nd specifically. And as we record today, May 28th, U.S. and Iran negotiators have reached a tentative 60-day deal where the Strait of Hormuz would reopen, mines would be cleared, and Iran would get sanctions relief, still subjected to Trump's final sign-off there. So if you think that this is the end of the story, I'd say there's a probably good chance that maybe this isn't the end, but we'll see how it goes. In general, however, if you watched our commentary from the first quarter, our halftime commentary, we showed you essentially this table that you're looking at right now, which showed history favoring staying invested during these geopolitical shocks. Markets, on average tend to drop for a few weeks. They tend to drop by about 10%. They tend to recover to a larger degree than that after that. And if this continues along the same path so far, anyway, this particular geopolitical shock is kind of following script, I guess you could say. Like I say, we're still not out of it yet, and there's still a lot more to be written about this. But if again, just following that playbook of wanting to stay invested during these things, not waiting for better news. This is following that same script as we've seen in the past. Oil started pre-war at about $72, and then really went up significantly. It peaked at we're looking at Brent crude as our benchmark, $138 on April 7th, and it fell on the ceasefire. It's still certainly elevated from where we began at around $97, but it's down 30% from the peak. And like I say, today we did get the news about at least tentative news about potentially a longer-term ceasefire, which we would certainly love to see if the deal does close. Analysts are estimating that oil could fall to somewhere around the $75 to $85 per barrel range, higher than where we started, but obviously that would meaningfully ease some of the inflation concerns that we see right now and potentially give the new Fed chair and the Fed itself room to cut. I'll throw over to Sam a little bit of a look on what we're looking at for corporate margin.
Yeah, well, the question we get a lot is, all this uncertainty in the world. We got rising inflation, unemployment, energy price spike, tariffs. How's the market doing so well? And I think this slide here shows a lot to support the reason why the market is doing well is because the market, it doesn't like uncertainty. It certainly does like profits, and profit margins are at record highs for the S&P 500 at 13.4%. It's over 2% above the historical average. So We're going to be looking at market valuations a little bit later on here, but important to note that those valuations are supported by record high profit margins, which has not always been the case with high valuations in the past. The risk to having these high profit margins is high expectations. So when profit margins are high and rising, investors tend to think they're going to continue to do so. And if that earnings growth does not come through and profit margins do kind of revert to the mean, that's what can lead to large sell-offs in markets. So something we'll have to be aware of. Certainly good news so far, but past performance is not indicative of future results, as we'd like to say. Looking at the Q1 earnings season, we had 84% of companies beating estimates in the S&P 500, well above the 5-year average of 78% and the 10-year average of 76%. So we're showing that more companies are beating estimates than normal, and they were also beating those estimates by a larger margin than normal, 20.7% above estimates on average, which is a pretty wild number to think about. 5-year average there is 7.3% and the 10-year of 7.1%. As mentioned, when expectations are high, it means if you were not one of these companies that beat their estimates, that you got punished pretty hard for it, maybe 3 to 5 times as much as you typically would in an average type of market. So demonstrates that expectations are high, valuations are high too, and we'll continue to watch to make sure they remain supported by profit margins. Also reassuring is that the earnings growth has been broadening. For a few years there, we were seeing earnings growth largely in the information technology sector of the markets and really nowhere else. Pretty jarring to see for a while. Seeing a lot more participation here, which is emblematic of a healthier market, more broad-based rally than just a few tech companies. So infotech still leading the way by a large margin. Energy obviously benefiting from the price spike, but also seeing financials, healthcares, industrials, representative of a growing economy and growing profit margins across the board. So we've seen more participation in the U.S. market outside of just those Mag 7 companies that have been really dominating the last few years. Next up, market valuations. They are high. They have been high. They remain high. So important to note that high valuations are not necessarily a good predictor of short-term returns. Really almost has nothing to do with how the market returns over the next year or two. But when you start to look at the 5 to 10 year time frame, that's when they start to have explanatory value. So I'm not going to sugarcoat it here. These valuations are high near the dot-com peaks. Again, I would say the caveat there is that earnings growth is much higher right now than it was during the dot-com cycle. So during the dot-com cycle, a lot of those companies were unprofitable, maybe had no profits at all, where today the biggest companies with the highest valuations are highly profitable. So that is a difference there, but high valuations do tend to kind of keep a lid on market returns going forward. So it's not crazy to expect that returns in the U.S. market will be lower over the next 10 years because we're starting with those higher starting valuations. The good news, as we always like to point out, is that U.S. markets are not the entire global market. A lot of other options out there that U.S. markets have been dominating really since the post-financial crisis. We have starting to see that flip a little bit in these last couple of years where international markets are outperforming. What they have going for them is much lower starting valuations, as you can see here, about half the valuation of the U.S. market, trading at about a 17 adjusted price to earnings ratio, much closer to its long run average. It's also benefiting from a weakening dollar as economic dynamics have been playing out around tariffs and people rebalancing into cheaper areas to avoid the concentration risk and the valuation risk inherent to the U.S. market. So still good outlook on the international side, kind of business as usual there. For a long time, we've been talking about how valuations on the international side are more attractive, but there wasn't really a catalyst to get people to give up on the U.S. market and rebalance their portfolios elsewhere. But we have started to see that these last few months with the war in Iran and the tariffs, and just again the level of valuations in the U.S. market. So would not be surprised to see that continue. Inflation update, big day. Not only do we have the announcement of the tentative ceasefire, as Jim will say, my hot take is that might not be the last tentative ceasefire we see, but I hope to be proven wrong on that one. But we also got this inflation report for April. This is the PCE inflation report showing some elevated numbers. Headline PCE, which includes food and energy prices, up 3.8% from 3.5% in March. That is some of the highest inflation levels we've seen in a couple of years. largely tied to the energy price spike from the closure of the Strait of Hormuz. Core PCE is the one that the Fed is more concerned about because that gets baked into the prices of everything. It does not include food and energy, but of course, if energy prices go up, then over time, the cost of shipping things goes up, cost of inputs goes up, all that type of stuff. So the longer energy prices stay elevated, the more likely we're likely to see core inflation going up, and that will create bigger problems for the Fed going forward. So far, that effect has been a little bit muted. I think both markets and consumers have been looking through this energy price spike, expecting that it will not be persistent and result in structurally higher energy prices. So able to swallow that jagged pill for the moment. If things continue, if things do deteriorate in the conflict in Iran, likely to see more inflation, which will continue to put the Fed in a difficult spot. But before we hit the Fed, we're going to take a look at the labor market as well. A lot of two sides to the AI story. On the market side, exciting as we've seen profit margins going up. That's what markets care about. And a big part of those profit margin spikes we've seen have to do with productivity gains from AI. One worker can have more output. That's good for corporate margins. However, the flip side of that coin is labor market and displacement, something we're looking at. Less of a concern, to be blunt, for the market than it is for the economy and for society. So it's important to separate those two things. But the risk of job displacement is certainly high with these technologies that can replace a lot of work typically done by humans. We haven't seen it to this point show up too much in the unemployment numbers. We are at about 4.3% unemployment, which is elevated, but not necessarily in the red zone. April payrolls were decent, up 115K, beating estimates. A lot of the job gains we've seen over the past couple of years have been in healthcare. That is a little bit of a red flag because healthcare hiring is not so much tied to economic fundamentals as it is to an aging population and the need for healthcare costs. So that's something to is a bit of a caveat in these labor market numbers. Participation rate, it's the amount of working age people that are able-bodied that are available to work. What percentage of them are actually working? Not a great number there, 61.8%. That is a little bit lower, showing people not having as much of a willingness to work. Wage growth, 3.6%, is now actually below the PCE inflation rate of that's around 3.8%. So people actually losing money in real terms with inflation outpacing wages. So that's something that we'll keep an eye on, potentially constrain consumers' budgets going forward if it continues. As far as the AI effects, about 50K or 17% of the layoffs were attributed to AI. Of course, not every CEO is going to mention AI when they're laying people off, so it may actually be a little higher than that. But what we are seeing is that the front door is closing, that people are limiting their hiring, throttling who's coming in. Instead, we haven't gotten to the point of people getting mass laid off, but it's certainly a tough place to be for new job entrances and entry-level workers out there. So that's what we're seeing so far in the labor market. Goldman Sachs says they're expecting 6 to 7% displacement over the next 10 years. I put that with a grain of salt. I think a lot of these things are fairly unknowable at the moment, and it will depend on the pace of technology and how people deal with it. The Fed, all leading up to the Fed. So we talked about inflation, elevated, labor market, unemployment, slightly elevated, and potentially weakening. That puts the Fed in a very difficult spot. At the same time, we have a new Fed leader coming in. Kevin Warsh was confirmed on May 13th, narrowest approval in history. So certainly some contention there over whether he's the right pick or not. He does have a reputation of being hawkish, which means more likely to raise rates than lower rates. More concerned about inflation than he is about unemployment would be one way to frame that. So that's actually interesting that the Trump administration has been pushing for lower interest rates for a while, and then the person they put into the role actually has a reputation for raising them potentially. He does have a lot of experience. This is not just one of Trump's friends coming in here to run the Fed. It is a guy with a lot of credibility, but he's in a tough spot. If they hike interest rates, they're going to risk weakening the labor market further. If they cut interest rates, they're going to risk inflation going up further. If they hold interest rates, markets aren't going to be happy because they like to have some certainty in which way interest rates are going to head going forward. So, all signs right now point to holding interest rates for potentially the next year, barring any surprises. And if we've learned anything these last few years, it's barring surprises is not a good strategy. So we'll just expect those to come later. kick it back to you, Jim, talking about
Sure.
midterms, something clients are interested in.
Yeah, that's, we've talked about what we've seen so far and what we're seeing currently. So yeah, let's look a little bit forward into the year. And this is the big theme that kind of comes up, is that 2026 is a midterm year. In other words, midway through a presidential administration. And that tends to kind of do things to markets that are actually remarkably consistent historically. The 12 months before midterm elections tend to not be very remarkable in their returns. They average only about 2.9%. But in the 12 months after a midterm election, with much better vision into what the rest of the administration is going to be facing as far as the political landscape, 15.4% is the average 12-month rate of return over that period of time. And with great consistency, there's been actually zero negative midterm years since 1950 following a midterm election. So currently polling is kind of leaning one way or the other from day to day, it seems. But really at the end of the day, the question that a lot of people ask is, does the controlling party actually matter in the way markets return? And the answer is really less than most people expect. Markets, frankly, have done historically over long term well under just about every configuration. The best one historically has been divided government. That tends to be the most market-friendly environment, simply because it limits major policy swings, so there's fewer uncertainties that come as from a policy standpoint. So our message is, we don't make portfolio decisions based on election predictions. We're looking at a situation where so far, year to date, the S&P 500 is already up, getting close to 10%, running well above a typical pre-midterm sluggishness. And that's mostly due to April's big recovery that we talked about. So history, if we're using it as a guide, just says be positioned before the election. Don't wait for some kind of an outcome that may or may not happen. Your plan is built for all of these scenarios, and it's built to kind of withstand whatever we get out of midterms. There's what we see as four key variables for the second half of 2026. And the number one, obviously, with today's tentative agreement, is whether or not the Gulf or the Strait of Hormuz opens up, and whether or not this gets approved, and whether or not we actually get a reduction in the costs of oil, because it changes the whole macro picture, whether, for the second half of the year, whether or not that opens up for us. Number two, obviously watching the Fed under new Fed Chair Warsh. As Sam mentioned, reputation for not necessarily being a big interest rate dove, and a Hormuz deal, though, could give him some cover to cut. Without it, we can expect higher interest rates for longer being the likely path. And numbers 3 and 4, earnings sustainability and the November midterms, both of which we've covered. History says, again, be positioned where you want to be before the election and not after. If you're waiting to kind of make your allocation decisions until there's more certainty after the midterm elections, usually historically that's not been a great strategy to have in place. Market, once again proved that staying disciplined through uncertainty tends to be the right call. Nothing more than that you need to look at than April's 10% plus recovery that came as a very unwelcome thing for people who sold in the first quarter, basically. And today ends again with potentially good news. We're again knocking wood and crossing our fingers that the issue in Iran gets resolved, that the Strait of Hormuz gets reopened, and that improves the macro picture for the second half of 2026. We're going to keep you updated as things develop. Again, your plan's built for this, and we're looking at this trying to point ourselves in a direction that takes advantage of tailwinds where we see them, but also that limits our exposure to the risks that we're also seeing at the same time, and hoping to get ourselves in a position where portfolios are best positioned to ride these kinds of uncertainties out. So that's what we have for you this halftime. We hope you have a great start to your summer, and we'll be here again midsummer to see what things are looking like in the next halftime report in the third quarter.
All right. Sounds good. Thanks for tuning in, everybody. Have a great summer.
Thanks again. See you guys.